And we start with gross expected income. Sometimes called gross scheduled income. Now, a couple of comments on when we're going to do these numbers. First of all, we do it on an annual basis, not a monthly basis. Everything is calculated annually. Secondly, when we're doing this on a pro forma basis. What does that mean? Meaning, what is the best case scenario or likely scenario that we can get this project to? It's more than likely that the numbers that we're going to run here are not what it currently is. So we're looking at, if it's terrible now, within 3 years, can I get it to this formula that we're about to lay out here? Okay? So when starters, gross expected income or gross scheduled income is if everything was rented at market rent, what would that number be? So if you had 10 units and rent was $1,000 a month, that'd be $10,000 a month, or times 12, $120,000 a year. Okay? So that would be the gross expected income. Now, what if it's currently half vacant? That's not in the equation. It's not part of the pro forma. Now, we'd like to know why it's half empty. Is it because the market stinks and 50% is the best it'll ever get? Or is it because the sellers ran out of money and couldn't fix the other units? Or is it poorly managed? Or, are they asking too much? Or whatever. We want to know why it's not at its best performing, but we're not going to discount it as a bad deal because it's currently bad. Does that make sense? Usually what you're looking for is something that needs work, that has problems, so you can go in and create value by making it perform better. If you're looking at a building that's fully performing, fully rented, and running like a top, chances are you're going to pay top dollar for that property. You're not going to get any kind of great bargain, right? Unless you get lucky. All right, so we start with gross expected or gross scheduled income, and that is the rents for the building at market rent. Now, how do we determine what market rent is? Well, again, the website I mentioned earlier will give you some of the ideas of what market rents are. You can talk to property managers that you're interviewing and ask them what it should be for that property. You can look on Craigslist or rentals.com or rent.com. There's a lot of ways to determine. Now, what if, and you know how sellers always say this, my rents are a little bit low, because they've been there a long time and I want to keep good tenants. First of all, that's the story everybody tells. Second of all, it's not true. You shouldn't discount rent just because someone's been there that long. You should give them rent raises. You should give other benefits, maybe, or first priority on, if someone moves out of a better unit or something like that. But you should not keep rent consistent in a market, particularly where we are now, where rents are rising fast. Because the problem is, when you decide you're going to do it, you can't jack them 30% in 1 year. And the funny thing is, a lot of times I see these pro formas, a lot of times the listing broker for the property will put one together for the owner. And they'll say, well, current rent is $800 a month. Pro forma for next year is $1,100 a month, a $300 a month difference. Now, it may be true that market rents are $1,100, but you can't jack people from $800 to $1,100 and not expect a lot of them to either balk or leave. So you have to understand there's pro forma and then sometimes there's reality. You have to ease those people up over a few years into the market rent. Now, that's if they're under market rent. And that's a good thing. I mean, you want to buy a building where market rents are low. Okay. What if market rents are less than they're getting? What if they say we get $1,200 and the market rent in the market you determined as $1,000? Could that be a red flag? Think about that one for a minute. Could it be a red flag? Why? Well, some of you are thinking, well, the units are nicer. No, same units. Oh, well, maybe they're offering, some sort of, other benefit. No, apples to apples. So why would it be a red flag? To me, it would be a red flag because the way you fill, and by the way, you want to look at the age of the leases, how long they've been there. So if, for example, it was 50% vacant a year ago, and now it's 100% occupied at $1,200 a month when market rents are $1,000, what does that mean? That means they probably didn't qualify them properly, or had loose standards, or didn't take a large security deposit or any security deposit at all. Okay? So that's how sometimes market rent being lower than actual rent can be a red flag. Okay? It's more likely than that. And here's another one. Let's say there are no leases, or they dummy up leases that say $1,200 a month, and the landlord, thinking he's going to sell it down the road, takes cash out of his pocket and puts it in the bank account and gives you bank statements showing the $1,200 deposits. That has actually happened. That has actually happened. And it's really difficult to know that. Okay? So, in the end, when we talk about doing due diligence, you want to do some door knocking and talk to some of the people one-on-one and make sure there's not some big disparity between what the seller is saying and what the tenants are saying. Although most of the tenants are usually insane, but we're all insane for being in this business. All right, so we start with gross expected or gross scheduled income. And then we subtract a vacancy factor. Now, vacancy. Vacancy. Okay, let's go over it. So, are we looking at actual vacancy, like current vacancy, historic vacancy, or something else? Think about that one for a moment. Historical vacancy, current vacancy, or something else? Well, remember, we're doing pro forma, but it should be. So we look at what the area submarket vacancy factor is for buildings of that kind in the area, and that's the number we use. Again, if it's currently half occupied, that's not the number we use, because we're looking at pro forma or best case scenario, okay, or likely scenario. So we put that vacancy factor in there. Now, within vacancy, there could be some splits that you might want to break down. Some people do this on a separate line item, but I'd like to do it all together under vacancy. One would be incentives. So if you offer, free rent for a month, okay? The other thing is, are we talking about economic vacancy versus physical vacancy? We're talking about economic vacancy. So there's a difference between economic vacancy and physical vacancy. Someone could be living there not paying rent. That's economic vacancy. Physical vacancy means no one's there. Okay? So we want to look at economic vacancy. Who's not paying? Okay? That counts as the vacancy. So incentives would be under vacancy, and some other et ceteras like discounts or, I can't think of too many off the top of my head, but some sort of something or benefit that you're giving that's costing you a vacancy factor. Okay. So if we subtract gross expected or gross scheduled income from the vacancy, what we get is gross effective income. Okay? So that's expected minus vacancy and et cetera, will give you gross effective income. Okay? Now from that, we're going to subtract expenses. These are called operating expenses. Now, this is where a lot of people make a boo-boo. on a small building, let's say a 10 to 12 unit apartment building, where it's listed by a real estate broker, and the broker prepares the pro forma, they're going to list the expenses. And what are the obvious ones? Well, the obvious ones are going to be, let's see, taxes, insurance, utilities, services like garbage pickup, lawn maintenance, snow removal, or other services that are regularly done on the property. And then they're going to put in a maybe they'll put in a number for repairs. And that's it. Well, if you remember the movie Back to School with Rodney Dangerfield when he's in the class with the economics professor, and the economics professor says you buy a widget for $1, you sell it for $2, you make $1, and he goes, wait a minute, you're missing a whole lot of stuff there. What about this? What about that? What about this? And he's like, the professor, of course, doesn't want that all that shady stuff doesn't go on in the legitimate business world, maybe in your world, but not the legitimate business world. But the joke is on the professor. Those things really do happen. Not that I'm saying there are illegal things you have to do. That's not my point. But there's a whole bunch of stuff that's missing. First of all, management. Now, if the listing broker says, oh, well, the seller manages it himself. Well, goody for him. I'm not going to manage it. I'm the buyer. I'm going to use a property management company. And the standard formulas that we're using here, standard industry formula, you must put in a management number. Even though the seller self-manages, even though they're arguing that you could self-manage yourself, no. The standard industry formula that's used by everybody puts in a management number. Okay, what else? They're missing. Well, accounting. Who's going to keep the books? Who's going to do the tax returns? If you've got partners, who's going to print out the reports, the regular reports? What about advertising? Okay? Now, on utilities, you've got different utilities. Some the landlord typically pick up and some the tenant typically pick up. So, electric, gas, obviously Comcast, things like that, the tenant is going to pick up. And the landlord will pick up almost always water and sewer and trash. Although, if the building has a master boiler for heat, then the landlord's picking up that expense, so it's going to be on the landlord's side. Now, a central AC is pretty uncommon, except on a newer, higher-end building. So, usually if it's a plug-in unit, it's electric and the tenant's picking it up. Now, in some markets, it's possible, where the demand is really high and supply is really low, that you can bill back the tenants for a pro rata portion of the water and sewer. Okay? They're called RUBS, R-U-B-S. Don't ask me what that stands for because I forgot. It's like reimbursement, I don't know. Look it up. It's called RUBS. I think that's, on a big building like 100 units where you have a significant number, there are companies that'll do that for you. They'll come in and calculate it out, and you can add that onto the rent. Personally, I don't think that makes sense. I think it makes sense just to, if you want more money out of the tenants, you just raise the rent. Especially on a 10-unit building, it's not even worth the effort. Okay, so bill back of utilities. Unless it's electric, that's 1 meter. So if it's like, let's say it's a house, like an old Victorian that was converted into 8 apartment units, and there's only 1 meter. Well, in that case, you're going to have to split it up and build them back. But if it's a regular built as an apartment building 10 units, then I wouldn't bother. Okay. What else? So you have taxes, insurance, utilities, service, repairs, management, accounting, advertising. What about me? Lawyer fees. You're going to have eviction, and you're going to have cleaning of units that are vacant. Okay, what else? Now, repairs, if the pro forma that the seller uses, which shows, usually so current year, last year, and anticipated next year or two, they're going to say repairs were X last year and use that as a number. Well, the problem with that is repairs are different from year to year depending on what breaks. So we break up repairs into short-term and long-term. Or sometimes the long-term is called a capital improvement versus an ordinary repair. For taxes, they're done differently. Ordinary repairs are expensed in the same year, where a capital expenditure is amortized over a number of years. So let's talk about expensive stuff, like a roof. Let's say the roof on the building costs $30,000, and the roof is, 2 years old. Well, then there's not going to be a big number in there if you're only planning on keeping it a few years. The roof's probably not going to go bad. But if the roof is 15 years old, then the useful life of that roof is 20 years. And you plan on keeping it at least 5. That means you have to put aside every year 1/5 of $30,000. That's $6,000 a year into an expense fund. Now, sometimes when people do this, that reserve fund, they count as an expense, and others count it as not an expense, just a line item for cash flow purposes. Personally, I think it should be in the expenses category. Okay, so if the boiler is $5,000 and it's 35 years old and it's got a useful life of 10 more years, or your inspector just says, hey, I think you got maybe 5 years left on this or 10 years left on it, 5,000 divided by the number of years, it's going to be into your expense ratio there. So you got to figure this. A building like a C-class that was built in 1965, okay, that's 50 years old. You got to figure there's going to be a number of some kind that's just going to wear out every year. Not just repairs. I'm not talking about, a dishwasher breaks and you fix it. I'm talking about the parking lot. I'm talking about the flooring. I'm talking about the heating, HVAC systems, windows, etc. Depending on the age of the building and how recently renovations are, you can take a percentage, like let's say 3 to 5% of the value of the building per year. So if it was $1 million building and it's 50, 60 years old, you got to figure $30,000 a year, which would be including the reserve. It has to be accounted for. If they had a good year last year, let's say 3 years ago they renovated everything, so in the last 2 years they didn't have a lot of expenses, that doesn't mean you're not going to have other things that need to be fixed. So don't believe the repairs are on, if you're looking at a 10-unit apartment building that's selling for $1 million and the annual repair bill is $3,500. That's a joke. That's a joke, okay? All right. Management, accounting, advertising, lawyers, cleaning, services, utilities, insurance, taxes. There might be HOA if it's in a development that has homeowners. There's sometimes you have apartment buildings that are like little cluster buildings in a park where each building pays an HOA fee. It's kind of rare, but you do see that. And then you have just miscellaneous. Other office expenses, phone. You might have employees in there, depending on how you do it. We'll talk about how to manage it later. But if it's a big enough building, you might have an on-site employee. Okay. That was the one I said, the vacancy, etc. If you've got an on-site guy who's like a handyman that can handle stuff, and normally rent is $1,000 and you only charge them $500, then it would go there. Okay, or it could go in expenses. It doesn't really Because the bottom line is when you take gross effective income, subtract all the operating expenses, you're going to get what's called the NOI, which stands for net operating income. Net operating income. Now that's a number that you need to know. Typically, a seller on a listing with a broker or in the pro forma is going to give you a number of what the NOI is. Remember, this is all annual. Annual income, annual vacancy, annual expenses gives you NOI, the net operating income. Now, remember, under expenses, there's one big thing that you write every month that's not in there. You probably noticed it's missing. What is it? It's payment on the mortgage. This has nothing to do with the mortgage. This is the performance of the building. The net operating income is vis-a-vis the financing of the building. So the mortgage payment is not an expense. Okay, it's not an expense. Okay. So let's see if we have any questions so far. We have a few. Michael asks, what's considered a good cap rate? We'll be going into that in just a few minutes, Michael. I'll answer that question in just a few minutes. Okay. Another Michael asks, what emerging market are we in now? I assume you mean Denver or Colorado. Your guess is Sellers Market 1, and your guess is about right. FYI. Okay, so we have our NOI. And what do we do with that number? Well, we're going to plug that number into some formulas. And here's where the basic algebra comes in. Ready for the good stuff? So far we've only done addition and subtraction. I'm sure most of you can handle that. So, the first thing I wanted to look at before we go into that is the expense ratio. Okay, so we had the gross income divided by the expenses. Okay? Or maybe it's upside down the other way. Doesn't matter. It's the ratio of gross income to expenses. So if the gross income, let's say a year was 100 grand, and the expenses were 50 grand, what would it be? It would be 50%. In which case I have it upside down. So it's going to be 50, okay, divided by 100, gives you 50% or 0.5. Okay, so your expense ratio, and by the way, is it gross effective or gross scheduled? It's done different ways. You know, it depends on how big the vacancy number is. If the vacancy pro forma is a couple percent, it's not going to change things drastically. Okay? So if we have gross income divided into expenses, and let's say that's 50%, that is fairly typical of a C to C plus class building, 50%. Now, again, it depends on what services the landlord's providing. If the landlord's providing heat or electric or, or some other services, that number could be much higher than 50%. There are some buildings where it's all bills paid, which is something you probably want to stay away from. They're usually tenants that are so broke and have such bad credit history they can't get a utility in their own name. Either that or they're just temporary people who aren't staying very long. So there are buildings like that, and their expense ratios are much higher. But again, pretty typical to be 50% on a C to C plus class building. Now, if the seller says it's 25%, he's lying. There's no way it's 25%. And they come up with these numbers because in the expense category, like I said, they don't put a maintenance fund. They don't put lawyers and accounting fees and management and evictions and all that other stuff, or advertising, et cetera, et cetera, et cetera. They just don't put that stuff in there. That's why the ratios are all out of whack. Okay, so we want to know that it's a good rule of thumb, by the way, to do that. So if just on the back of a napkin formula, if someone says I've got 10 units, and you say, what does each one rent for? 1,000. Okay, so that's 120,000 per year. Right? 10 times 1,000 is 10,000 times 12 is 120,000 a year. You can pretty much guess that the expenses are going to be about half, and thus the NOI is going to be what? 60K. Wow, that was pretty quick. As a rule of thumb, that's you want to do the actuals, but if you're having an initial discussion with someone, and they say they don't know how to calculate, they're just not sophisticated enough to calculate formulas, and you could get out of them how many units, how much a unit, what services are you providing, and if it's typical services that are not out of whack, just divide by 2, and there you go. It's 60 grand a year. That's your net operating income. Wasn't that easy? Okay? That's what I call the back of the napkin formula. Now, we can figure out the value of the building in the same way, which I'm going to show you in just a moment. So, if we take the net operating income, okay, and we divide that by purchase price or asking price or offer price, whatever number you want to plug in there. But let's say it's the purchase price that you are offering or that you're going to base your numbers on. Okay? That is going to give you your cap rate. Okay? So NOI divided by purchase price is cap rate. Now again, we haven't done anything with financing in there. And I said earlier, cap rate has nothing to do with the financing of the property. No matter how much you put down or your interest rate, it's irrelevant. There are other formulas, we'll take that into account later, but cap rate is just a measurement of the building, okay, vis-a-vis the financing. Now, if we had the NOI, let's say we knew what the NOI was, and we said it was 60,000, and the seller is asking 600,000. What is the cap rate? It's 0.10 or 10%. Which, by the way, is an excellent cap rate. Now, again, I'm not talking about actual, I'm talking about pro forma. It may be half vacant at this point for whatever reason. And as long as it's possible to solve that problem and get it to full occupancy, that's your number, 10%, right? 10% cap rate, which, by the way, is very good. Now, a question someone already asked is, what's a good cap rate? It all depends on a lot of factors. What city you're in, what services you're providing, what class of building. Typically, in places where the prices are high, like California, you'll be looking at lower cap rates because the prices compared to rents are a little out of whack. Where if you go to Texas, Dallas, or Indianapolis or a place like that, you will find very good cap rates. So California may be on a C plus building, let's say maybe 6 to 7% or 5%, whereas in Texas it might be pro forma 9 to 10%. Okay? The idea is you find a building that is currently underperforming and get it to a better cap rate and then sell it at a lower cap rate. Now, you may have just lost you there, but follow me here. In algebra, if we have x equals a over b, you can switch these two. X and B, and the formula works the same. Trust me, if you don't know that, just trust me. It's the same thing, just backwards. So if I said NOI divided by the cap rate that you find acceptable, that you're looking for, that will tell you what you should pay for the property. So again, our example where we have a seller who's somewhat unsophisticated, doesn't know how to do, you ask him what's the NOI, what's the cap rate, and he looks at you like, duh, I have no idea. He has ledger books that he writes stuff in. He doesn't even have a computer program. He collects rents in cash and probably puts them in his pocket. You're going to have to figure it out. So if the seller's, again, has 10 units, and it's $1,000 a month, so we got that $120,000 a year, and we said 50% expense ratio, which brings it down to 60. And we're looking in this particular market, we think we can get potentially, when things are fully performing, a 10% cap rate. So divided by 0.10, what do you get? A purchase price of $600,000. You see how you can do this backwards on a napkin? So if you do this on a napkin, and he says, and you come up with $600,000, and he goes, I'm asking $1.1 million, you're way out of whack. You're not even in the same ballpark. You're not even in the same game. Okay? If he says $650,000, you're pretty close. I mean, you're pretty close in terms. Now, I said you want to buy it at a underperforming, get it to a high cap rate, sell it at a low cap rate. Because if I take 60 and divided it by, let's say, this is going to be hard enough to do in my head, but let's say 0.12, 12% cap rate. What's the building worth? What's the building worth? At a 12% cap rate. Okay. $500,000. That's what you're paying for it. So the higher the cap rate, the less you're paying for it. Does that make sense? You'd have to pay $500,000 to get a 12% cap rate. Now, if you bought it, if you got it up to a high cap rate, like 12, okay, and then you sold it at the market cap rate, which was typical for buildings like that, let's say is 9, then you're going to make a profit. Trust me on that. Just do the math. It does make sense. So purchase price, what you want to pay is the NOI divided by the acceptable cap rate that you're looking for. Now, the market cap rate for that building in that area may be 7%. That doesn't mean anything to me or you. We want 8 or 9. And if we want 8 or 9, we're going to have to buy a building that needs work, needs some love. If the building is fully performing, you're going to get it at a 6 cap rate or a 7 cap rate at best. All right, because there's no room, there's no blue sky. If everything's rented at market rent and everything's been fixed, everything's been repaired, it's all managed well, the seller's probably not going to be motivated, and he's going to sell it at a lower cap rate, which means a higher price. Does that make sense? Okay. Now, see if we have any questions on cap rates so far. Okay, so I hope that answered your question, Michael, about cap rates. The next formula we're going to look at is what's called net cash flow. Net cash flow, NCF. Now, how do we get net cash flow? Let me explain it to you conceptually first. Net cash flow is the bottom line that you're collecting in your pocket over a year. Now, if you have no mortgage, you're going to have a lot. In fact, your net cash flow is exactly the same as your cap rate if you own the building free and clear. If you pay cash for it, your cash on cash return is the same as your. Does that make sense? So, to calculate, I'm sorry, I'll put this over here. NOI minus the mortgage payment, that's the P&I only, because remember, in the NOI, we've already taken out taxes and insurance. So NOI minus the mortgage payment is equal to the net cash flow. Okay, so when I say NOI, it's income minus vacancy minus expenses. If you subtract from the NOI the mortgage P&I payment, the principal and interest payment, you get the net cash flow. And that's the bottom line you're collecting each year. Now, if you divide the net cash flow by your investment, that is, how much in dollars did you put into this investment? So if you put 20% down, you're going to take that plus if you did an inspection, an appraisal, and an attorney's fees and closing costs. It's your all-in. This is your all-in number. Now, when I do some examples, I might just omit everything but the down payment to make the math easier. But understand that the denominator is your all-in number. That's your total investment. Okay? And that formula gives you what's called your cash-on-cash return. Remember, this is all annual. Cash-on-cash return. Now, is this different from cap rate? Yes, it is. Because this takes into account the type of financing. So the bigger your mortgage, it's going to affect cash-on-cash return. The less money you put down, the higher your cash-on-cash return. Does that make sense? Okay? The higher the interest rate, that means the less net cash flow, which means a lower cash-on-cash. A 15-year versus a 30-year mortgage, that's going to change it. The interest rate, how much you put down, etc., etc. That's all in this mortgage P&I payment. So that is very relevant to cash-on-cash return. Now, if you were going to keep this building forever, that's all you want to know. That's all you need to know is that number right there. Okay? But if you planned on selling it, let's say in 5 years, what you're going to want to know is your rate of return for the 5-year investment. Now, if you think about it conceptually, if you got X dollars a year for 5 years, and over that 5-year period, rents went up, and you managed to get expenses consolidated to go down, so your NOI went up, that means at the end of 5 years, you should be able to sell it for a higher price than you paid for it. Plus, if you had a mortgage, it might pay down in principal. So your total return, or average rate of return, is done by taking the cash flow for the 5 years plus the back end chunk of money and then divide it back under this formula. Okay, let me give you an example so you see how this works. I'll start with a very, very simple example. Let's say you bought a condo and you paid 50 grand for it, cash. Now, let's say that your NOI, that means your income minus taxes, HOA, and all that, is $5,000 per year. Okay? So, what would your cash-on-cash return be? Well, first, what's your cap rate? NOI divided by purchase price, which gives you what? 10%. 10% cap rate. So what would your cash-on-cash be? The same. 5,000 divided by 50, because there's no debt. When there's no debt, your cash-on-cash and your cap rate are one and the same. Now, typically, your cash-on-cash return should be better than your cap rate if you have financing. Okay, let me say that again. Typically, your cash-on-cash return should be much better than your cap rate as a number if you have financing. Otherwise, you have a crappy loan or you put too much down. Now, let's say you got $5,000 a year times 5 years, which is a total of $25,000. Okay? Now, let's say at the end of the 5 years you sold it, because the market went up, for $75,000. Now again, I'm omitting broker's fees and closing costs just to make the concept easier to follow. So 75, the sale price, minus 50, what you paid for it, is a $25,000 profit. So we made $25,000 on the back end, and we made $25,000 in income over the 5 years. So our total is $50,000. Okay? Now, if we divide that by the 5 years, what did we get? We got $10,000 a year on average over the life of the investment. So even though we got $5,000 in income, if you add in the profit at the end and then divide it back, we actually made $10,000 per year over 5 years. Now we take the $10,000 a year and divide it by our initial investment of $50,000, and what was our average rate of return? 20%. So the cap rate initially was 10%, but after 5 years, since we sold it for a profit, we calculated that back in, we ended up with an average rate of return for the last 5 years of 20%. I hope that makes sense. Now, it'll be much higher if you have debt in there, because if you have a good loan and you leverage, the number's going to be much better than if you paid cash for it. And I'll go over an example in just a moment. Now, there's another number, or formula, called internal rate of return, known as an IRR. Now, the formula is too complex to do on the screen. Okay, you've got this, a couple of sigmas in there, those things, and believe me, it's math way beyond basic eighth grade algebra. The good news is most software programs for apartments will do this for you. So the thing is money now is worth more than money later. Make sense? So if you've got $5,000 a year for 5 years, and then 25 at the end, for a total of 50, would you rather have it that way, or would you rather just have $50,000 a month after the investment? Of course you would. You'd rather have it a month later. So there's something called present value. So the present value is the present value of a future income stream, and that's what internal rate of return figures in. So the average rate of return is 20%. The internal rate of return might be 16 or 17%. And that's the real number of what you made on your money on the investment. The internal rate of return. And I said earlier, this is what's called a modified internal rate of return, which takes into account the fluctuations, because you might not get the same rent every year. You might have vacancies and different expenses. But most people don't look at that. They look at internal rate of return. Average rate of return is easy to calculate because you can do it like this, a basic calculator. Internal rate of return requires a spreadsheet or a software program. Okay? But typically, IRR, internal rate of return, is lower than average rate of return. Okay? Don't worry if you don't follow all the numbers. Just conceptually understand that if you made X amount a year for 5 years and then got a chunk at the back end, you'd add it all together, divide it back, and you'd come up with your annual average rate of return. Okay? All right. Let's put this all together in an example deal with some real numbers. In the apartment realm. That was just a simple condo example, so you can follow me. Let's put it into some real numbers. Let's say you bought a triplex, 3-unit apartment building. And let's say no. That's too small. Let's say you bought, let's go back to our 10-plex. Remember that with the 10 units that rented for $1,000 each? So we have 1,000 times 10, which is monthly 10,000 a month, so times 12, which gives you 120,000 a year. Okay. And then we're going to subtract vacancy. And let's say that's 5,000 a year. C. And let's say we had some operating expenses in there, which were 55,000. And therefore your net operating income is $60,000. Well, gee, look at that. Our expense ratio of 50%. That worked out pretty good, didn't it? Obviously, I'm doing the math to round numbers so you can follow me. Okay. So your NOI is 60,000. Okay. And let's say that you paid for the building $600,000. So your cap rate is your NOI, 60,000, divided by the purchase price of 600, which equals 0.10 or a 10% cap. Okay, is that good? That's excellent. Now remember, it's pro forma. This is not actual. If this was actually filled up, the guy's not going to sell it for 600,000. He's going to sell it for 800,000 or 900,000, which means your cap rate would be a lot lower. We're looking at, potential here, not actual. So let's say the potential, it could be a 10 cap. We like it. Then we subtract. Let's say we're going to put. Let's say it's a seller carry. Let's make it simple. With $100,000 down, and let's see if we can figure out a simple payment. I'm going to do interest only, just so it's easy to calculate. And besides, I can do that in my head without a calculator. So let's say we did 6%, which is 100,000. 6% is $500 a month times 12, which is. Oh, I'm sorry, I did it backwards. 100,000 down, which means $500,000 loan. So it's $500,000 times 6% would be, and if it was interest only, would be $30K per year in interest payments. Okay. Now, if it was amortized 15 or 20 years, the number would be higher. But let's just use simple numbers for the example. So if we take our 60,000 NOI and we subtract our $30,000 mortgage payment, our net cash flow is what? $30,000 per year. What is our cash on cash return? It would be $30,000, our net cash flow, divided by the $100,000 we put down, which equals a 30% cash on cash return. Is that good? You darn tootin', that's good. That's excellent. Personally, I think a cash on cash return of 12 to 15% is good. It's a good cap rate. But if you can get 15, 18, 20 pro forma, you're doing really good. Okay? So what's our average rate of return? Let's figure that out. So we got $30,000 per year let's say times 5 years, is $150,000. Okay? We paid $600 for it. Now, if this was an amortizing loan, the equity would have gone down. Okay? But it was an interest-only loan. Okay? But let's say because rents went up over the years, which means the $30,000 number would be bigger, but let's just say appreciation-wise, it went up to the point where you sold it for $750 after broker's fee. Okay? We paid $600 for it, and therefore we made $150,000 profit. So we take our $150 in cash flow plus our $150 in profit, we get $300,000. We're going to divide that by 5 years and get $60,000 a year. And if we divide that by our $100,000 investment, what do we get? A whopping 60% average rate of return. Nice. Very, very nice. Now, here's one thing you have to understand. If we are going to bring in a partner, let's say you didn't have any money for that $100,000, you brought in a partner to put up the $100,000, okay, and you gave him half the deal, okay. What would your rate of return be? Well, infinite. You didn't put any money. What would his rate of return be? Well, his cash on cash, we said, was 30% for the deal. If you give him half, his cash on cash is 15% a year, and his average rate of return is half of this, which is 30% per year. Now, what if he says, I'd like a better return? Well, you're going to have to slice and dice the percentages so that you get enough return for the investor putting up the money. So maybe you get 30% of the deal, and he gets 70% of the deal. You put up no money, he puts up all. He gets a better rate of return. Well, you get an infinite rate of return, but he gets a better return than if you gave him half of the deal. Okay? I hope that makes sense. Okay? All right. Another formula that we're going to look at, and this is not as important when you're doing seller financing. It's more important when you're getting bank financing, and that is the ratio of net operating income to your mortgage payment. Okay? So that's the debt service coverage ratio. Let's say your net operating income was $120,000 a year, and your mortgage payment was $100,000 a year. So what do we have? 1.2. Okay? That's typically the minimum a lender wants to see. Most lenders are going to want to see 1.3, some even as high as 1.4. What they want to see, they don't want to see break even. Okay? They want to see that you've got enough income so if you had a bad year, you could still pay your mortgage. So typically debt service coverage ratio, you want to see 1.2. Personally, if I was going to do like a seller carrier or something like that, I'd like to see it at least 1.5, if not 2.0. That's what I think you should be looking at. Okay. Again, a lender is going to want to see 1.2. If it's a negative number, if it's less than 1, no good. No good. Okay? That means you're not breaking even. Now, in the first year, you might be losing money. That's fine as long as you have a reserve. But pro forma, it's got to be at least 1.2. Okay? Now, we talked about, finding a deal and, slicing and dicing it with partners and things like that. We talked about the fact that if you're looking at a building that's perfectly performing, running like a top, fully rented, very low vacancy, managed, no repairs, no deferred maintenance, you're going to pay a pretty penny for that, which means you're going to get a lousy cap rate. Okay? So, what we're looking for is what we call value plays. We're looking for a building that has a problem, that you can add value to it. And what are some of those? It's poorly managed. And that could be, self-managed person who is just getting up there in age and doesn't have the time to really attend to things, or doesn't know what he's doing, he's in over his head. It could be someone who died and the spouse inherited it, and he or she doesn't know what they're doing, certainly, and it's being poorly managed. There's a lot of reasons. It could be a bad management company. So poor management can be a source. B, seller out of money. So there's a 10-unit building, but 3 of them are unrentable because major damage caused by tenants and they don't have the money to fix it up. Or there's a leaking roof that leaks in those 3 units so they can't rent them. Whatever. They ran out of money and therefore it's not performing at what it should be, which is a value play opportunity for you. C, rezoning. So if the area is being rezoned so that now your lousy C-plus apartment building is going to be in a B-plus school district because of rezoning or redistricting, that could be good. Or the area around it, which was industrial, is being rezoned for shopping malls. Look for opportunities like that. The example in Denver was the rezoning of making that Fitzsimmons campus, and across the street from that was a bunch of motels and trailer parks, which were the city threw them out, and now we've got commercial buildings, hotels, and things like that. Great opportunity for a value play. Okay. D, improvements to the property. So just by making it nicer, redoing the facade, putting new carpet and paint, updating the kitchens and bathrooms, the common areas upgraded, the parking lot, whatever. Any kind of improvements to the property, you spend money, gives you the right to charge more money to the tenants because it's a nicer building. And if they can't pay, bye-bye. And typically, when you've got a situation where the seller's out of money, and let's say we said there's 10 units and 3 are down because the seller doesn't have enough money to fix those 3, what you want to do is fix those 3 up and then move 3 tenants in the old ones into the new ones at a higher rate. Then fix those 3 and move 3 more tenants from the older ones to the newer ones at a higher rate. So you move them in chunks. That's the best way to do it. Okay. E, provide services and amenities. So additional parking, or parking if there is no parking, storage lockers, a rec area, a swimming pool. There's lots of amenities that you can offer that you can charge extra for. A laundry room, or et cetera, et cetera, et cetera. By the way, on a small building, I recommend that you hire a service to do that. There are companies that'll provide all the maintenance. They'll make sure it's working. They'll collect all the money out of the machine. They just give you a percentage. That's the best way to do it. Because if you have your own washer dryer, it's always going to break. They're going to call you up and complain, and it's just not worth the effort. Okay. One building I looked at was kind of neat, though. It was a couple 100 units, and they had swipe cards. So you go into the main office and you buy credits. Let's say $10 worth of credit on a swipe card. You go into the laundry room and you swipe. And it's so brilliant because at the end, when people leave, inevitably they've got credit that they haven't used, which they don't get refunded for. It's sort of like American Express traveler's checks. The biggest ripoff in the world. You give them money, they give you this thing you carry around for a couple of weeks. You come home, you haven't used some of it, and you wait 3 more weeks before you go cash it in, and meanwhile they're catching the float for 6 weeks on your money. It's ingenious what American Express does. Okay, where were we? Services and amenities. Reducing expenses. So, on one particular building, we had a laundry room. And the water bill for that laundry room was way more than the income we were making from the laundry. So we shut it down. Besides, right next door to the building was a laundromat. So it's not like they didn't have a place to do their laundry, but we looked at the numbers that said, let's just shut it down because the water and sewer charges were more than we were collecting from income from that. So that's a way of reducing expenses. Consolidating things. Where you're paying for this and that, or renegotiating contracts, etc., etc., etc. G, refinance a loan. So maybe you can work a deal with the seller where you can assume their loan and then renegotiate the terms with the lender. Or take it subject to, which we'll talk about more with financing later, and then refinance it later on. So there are ways to change the cash flow from a 20-year to a 30-year, etc., etc. Okay? H, appreciation. Just natural appreciation in the submarket you're in. If your projections based on your research is that over 5 years it's going to go up in value 5% a year, that's tremendous. Even if nothing else happens, you're going to make money. Okay? And along with that, rising rents. Now, rents are rising dramatically in a lot of markets. And with that, if rents went up 5% a year for 5 years, and that would raise the value of the building significantly because your net operating income would go up. All things remaining the same. Okay? And the last thing would be the area redevelopment. So, the city, town, or whatever, Parks Department builds a new park, a golf course, or other things that were once an eyesore and now are going to be good. Change a garbage dump into a park. That would be an area example of the area redevelopment factor. Okay. So, and this is just not an exhaustive list, but just some things you're going to be looking out for when you're looking for value plays. That is, opportunities to buy things at a better deal so that you can get a better cap rate later. And again, if you don't get that, let me explain it again with cap rate and the relationship to price. So we said NOI divided by the purchase price equals your cap rate. The bigger the denominator, if this goes up, the cap rate must go down. That's just basic algebra. A over B, if B is bigger, it's a lower percentage. Okay? So, if the building's performing really well, and the seller wants to sell it at a really low cap rate, that means you're going to pay a much higher purchase price. Just the way it works. But if it's currently, you're buying it at a discount, and your cap rate existing is 5%, and you can get it to a 12%, and then sell it at an 8%, that, my friends, is how you make money. Okay? And remember, all the formulas are based on pro forma, what if, or best case scenario, or what is the likely scenario, not what actually is. Okay? So, how do you know if the seller's lying? His lips are moving. We're going to talk about due diligence later and things you're going to look, checklist for that. But, you know, just take with a grain of salt the numbers that the seller or his broker is giving you, do your own due diligence. All right, let's see if we can go to some questions. Right. So Kimberly mentions in different markets with different class properties, you should expect different cap rates. Absolutely true. So, for example, a C-class property in a market with little appreciation that have little growth potential. And you're from Youngstown, Ohio, which I don't know how it's doing these days, but if I recall, that's a market where things are pretty flat. So when you're figuring in your cap rate, you're not figuring in rising rents every year. It's going to be steady rents. And that will affect what the cap rate will be 5 years from now. If it were in an area where rents were rising, 5% a year or more, then obviously the cap rate in the future would be much higher. So that's a very valid point. Okay. Michael asks, why would an investor sell the apartment after 5 years and lose all the great income instead of keeping the building forever? Well, there's two ways to do this. Buy low, sell high, and get your money out. Or buy something that has great fundamentals and keep it forever. If you're bringing in partners and they want an out somewhere, you're selling it as you're getting your money back in 5 years, then that's what you promised, that's what you get. Now, you can always, at that point, buy some of them out and ask some of them to stay for another 5 years or even longer if it turns out the rates of return are excellent. So it's all a matter of the investor's priorities. Okay. Here's another question from Joe. Can you explain the difference again between average rate of return and internal rate of return? Yes. Average rate of return is calculated by your cash flow, let's say, over the life of the investment. And let's say the life of the investment is 5 years. If you receive some cash in year 1, some in year 2, 3, 4, 5, and at the end of the 5th year you sell it and you make a chunk of money, we're going to add it all up, divide it back over 5 years, and calculate our annual cash on cash as an average. Now, money later is worth less than money now. It's the time value of money. Okay? So based on the present value of that future stream is where you get your internal rate of return, which is going to be lower. And by the way, the longer the term of the investment, the greater the difference between average and internal. So if it's a 20-year investment, obviously the present value of that 20-year income stream is much lower than if it were a 5-year investment. And thus your internal rate of return would be lower. I hope that makes sense. Okay. Okay. All the questions we have right now. This would be a good time to end our session and break for lunch. It is about 10 minutes to 12 Mountain Time, or 10 minutes to something, wherever you are. So we're going to take a break for 1 hour and 10 minutes. So we're going to start up at 1 o'clock Mountain Time, or whatever time that is. That's 3 o'clock Eastern Time, or I believe that is 12 o'clock Pacific Time, or something. You know it better than I do with your watch. So we're gonna break for 1 hour and 10 minutes. Take a look at your notes, gather up some thoughts, email me some questions in the meantime. Be happy to get to them when we come back. When we come back, we're going to talk about ways to find deals. We're going to talk about analysis. We're going to talk about due diligence. We're going to talk about financing. We got a whole bunch more. Let me know how I'm doing. Drop me an email and just let me know, if there's topics that I haven't covered that I may want to cover. And again, if you weren't able to write down all of the things that I put on the board, I do have a written outline which I will email to you, or actually will put it in the location where the video replay is, so you can download that as well and take notes on that. All right, we'll see you after lunch.